Hi, and welcome back to the Business Career College video series. In this video, we're going to have a look at taxation of life insurance, as we've been looking at in the last few videos. Specifically here, we're going to look at the calculation of the adjusted cost basis of a life insurance policy. Now, ACB, as you may have seen already, becomes fairly important anytime we have a taxation of life insurance discussion, which is not thankfully all that common. For the most part, people just pay their premiums for whatever period of time and then either let their policies lapse, which generally doesn't have tax consequences, assuming there's no cash values, or they pay premiums until they die and there's a death benefit paid, and that death benefit is tax free. So we're only looking at ACB here so that we specifically understand what happens when we have a taxable disposition of a life insurance policy. You may have to go back and review the video that covered the events that constitute a taxable disposition of a life insurance policy. So there are two ways to calculate ACB, and it depends on when the policy was last issued or last acquired, what we call the last acquired date. And that basically means the date on which the policy was purchased. It can also mean if the policy was allowed to lapse and then reinstated, that resets the last acquired date. A change of ownership also resets the last acquired date. So we have one set of rules that applies to policies issued quite a long time ago now. We're looking at policies issued prior to December 2nd of 1982. These policies actually have a very basic set of rules that applies to their calculation for ACB. For these older policies, the ACB is equal to premiums paid minus any dividends, as in the sort of dividends that would be paid to the policyholders in participating whole life policies. These policies also are considered to be always exempt from taxation. We'll look at the exempt test in a separate presentation. So that's our older policies, and policies where we've not changed anything substantive about the policy since December 2nd, 1982. Now what happened was, under these old rules, it actually was very easy to manipulate an insurance policy to take advantage of the lack of an exempt test here. And basically what was happening is people were using endowment policies as an investment, really, rather than as insurance. And the reason this was advantageous was because it was tax exempt, unlike ordinary investments, which had to be taxed on an accrual basis. So this gave a significant tax advantage to using life insurance in a sort of manipulative way to invest. And the problem here was that people were really investing tons and tons of money and taking advantage of sort of a loophole that was designed to really create favorable taxation for life insurance, but now they're treating their life insurance like an investment. So in 1982, in a mini budget in December of 1982, the actual date was December 1st of 1982, and this is when any policies issued or acquired after this date, now post December 1st of 1982, are issued under a different set of rules, where the ACB on a modern policy still equal to your premiums paid. But now with this ACB, we're going to take out any costs of riders and benefits. So any riders and benefits you have that you add onto your policy do not increase your ACB, except we will include term riders. So term rider, the cost of a term rider does increase your ACB. And we're also going to take out any cost for any substandard risks. That is, if you have somebody who's rated, for example, and that person pays a higher premium than other people like them because of, let's say, poor health, we do not include that higher premium in calculating the ACB. We will also take out these dividends as we did with the older policy structures. And again, those dividends would probably be paid out of a par whole life policy. And now we're going to take out at the same time what we call the net cost of pure insurance. Now, this is a concept we've seen briefly here and there. What the net cost of pure insurance really relates to, this is roughly the cost of a 1-year non-renewable term contract. So we would just find your mortality on this chart or this graph that we've seen over and over again, and that's what would give us the net cost of pure insurance for that particular year. As you've seen, that net cost of pure insurance does increase quite a bit, and it really starts to increase at a quick pace later on in life. So because this NCPI, or this net cost of pure insurance, gets so high later on, it actually will bring your ACB back down to 0 if you live long enough. So your ACB will start at 0 and end at 0 if you live long enough. It'll peak out usually sometime in your mid-60s or thereabouts. That obviously varies a little bit from situation to situation, but that's generally what you'll see, is that NCPI gets back down to 0 if you live, or sorry, ACB gets back down to 0 if you live long enough, simply because that net cost of pure insurance gets so high later on. So if you want to see some numbers here, which is a question that I get a fair bit, what you might look at is a universal life contract. So let's look at a sample UL contract under the new rules. And it's pretty easy to see how this works. So let's say we have somebody who is paying a premium of $2,000. This person is paying a premium of $2,000, and that premium, an annual premium we'll say, that premium comprises, as we've previously seen, 3 elements. It comprises our mortality costs, it comprises our investments, and it comprises the expenses associated with this policy. Now let's say that we have, we'll just try and keep this basic here, let's say that we have mortality costs of $400, expenses of $100, and investments of $1,500. And let's say that out of this mortality cost, we have $200 of that's related to your pure risk, and then we have $200 of that comes from a rating. We'll try and keep this as basic as possible. So this $200, the first $200 we see here, will increase the ACB. We can tie that. We look back up here. That's our premiums paid. Sorry, the whole amount is our premiums paid. So we've got a $2,000 premium. But right off the start, we can take out the cost of a substandard risk. We don't have any riders or benefits here, so we won't worry about that. But we can see that this cost here is related to a substandard risk, and it comes out. This first $200 is just related to the basic risk. This next $1,500 is invested. We don't see that coming out anywhere. That's just premiums paid. No problem. That will increase your ACB. And this expenses will also increase this person's ACB. So we can see here that we've got 200 plus 1,500 plus 100, $1,800 that would increase the ACB, but now we have to take out this net cost of pure insurance. So we have to find this person on this graph, and this is a figure you have to get from the insurance company. It's not something you'll have readily available. Let's say, just for the sake of argument, we have a $100 NCPI. We can see that that figure would be a little bit more in each subsequent year. But for now, let's say that it's $1,700. So roughly, what we end up with when we're calculating the ACB for an insurance policy, it's roughly equal to the actual investment dollars put into the policy. It doesn't always work out perfectly, but that's roughly how it works out. I hope that helps to understand the adjusted cost basis of a life insurance policy. It is a fairly fundamental concept with respect to taxation of life insurance. Any type of tax discussion around a life insurance policy, you're always going to have to refer back to the ACB. You'll probably never have to calculate it. Insurance companies will calculate the ACB for you and tell you what the ACB is, but it is important to understand how the ACB is arrived at. I hope that helps. Enjoy your studies. Thanks.